I'm joined today by Mike Graziano, Managing Director with Goldman Sachs. Mike, last time we talked, the recapitalization of the REIT industry had just kind of gotten started. In your estimation, how do you think REITs have handled this whole process?
Look, I think everybody realized there needed to be a massive re-equitization of the space and knew that every REIT would have to sort of tackle that problem in their own individual way based upon their own situation. I think at the time, that people realized that folks thought that the public markets would play a large role in that event. I don't think anyone fully anticipated that the public markets would play the role in that event, where really almost all the re-equitization of these businesses has occurred through the public markets, and I think there's probably more to come over time. But at this stage, folks have really worked through the majority of their problems, avoided the Armageddon scenario, and we're sort of in that recovery mode.
And looking ahead, when you look at it, the debt maturities still to come, is there more caution?
Yeah, there is obviously a massive amount of maturities over the next couple of years. I would make the argument that it's actually more of a demand issue than supply on the capital front. I actually think a little bit of a contrarian view that there is an awful lot of capital out there ready to be put to work on the mortgage finance side of the business. And certainly, as we just discussed, the public markets are wide open. And as an example, we as a firm are more than willing to finance 60–70% loan to value on almost any kind of asset class. And the issue you have is the folks that have their balance sheets in terrific order are saying that's really interesting, and it's great news that is now available at reasonable pricing. But I can access the unsecured markets as well, so I'm not sure whether I want to start securing assets right now. And then you have the much broader universe potential borrowers that say that's also fantastic, good news, it's about time we've had some good news, but I need 90% loan to value, I need 110% loan to value. And for them to take this money now, they really need to have an equity infusion to sort of recapitalize projects, portfolios, or companies. And honestly, for them, it is a much better answer if they continue to just kick the can down the road and wait to try and grow out of that leverage problem.
And there was a lot of expectation that once all this capital was raised, that M&A activity would just start running wild.
Right.
Haven't seen that yet. Why and when do you think it'll happen?
Yeah, there's always a lag, and you're going to see a lag here. I think it's starting. There's just a period of time where there's going to be a lag. I think folks needed to get comfortable that they had their own houses in order. If you remember back to the dark days, every single company was on the bankruptcy list. Some were just at the end of it, and some were at the front of it. And most folks, as I mentioned, now have their balance sheets in very good order, and the better capitalized entities are really just starting to think more offensively. And I think there's a number of M&A situations that are just starting to percolate. Again, there'll be a lag, so it'll take a while for that to sort of show itself. But you're going to have that. I think this is the year you're definitely going to see the overlap between folks turning more offensive on one side of the equation, and folks, as we just discussed, sort of running out of room on the kick the can strategy or running out of runway, with lenders, and you're going to see a lot more trades at both the asset level, portfolio level, and corporate level.
Great. Mike, thank you very much.
You're very welcome.
For REIT.com, I'm Matt Bisher.